On the corn side, we have both some bearish factors and some bullish factors. Brazil continues to have record corn production, and the estimates have risen even recently relative to what they were just a month or so ago. They do have rising domestic demand though, so they are consuming more of that at home, which I think offers some opportunity for us on the export side, and maybe in the form of less competition. Not necessarily a reduction in exports and competition, but less growth in competition. And on the new crop side, we have record U.S. production estimates and yield forecasted, and we'll talk about some of those factors here in just a minute. On the bullish side, old crop exports continue to exceed prior expectations, and so we've seen a really good export campaign there. And we could see fairly strong demand in 2026 going forward. And so I think all of those are good upside factors in the corn market. Looking at the harvested area change for August, this was one area of large surprise to both myself and the market at large. In the August WASDE, we saw them revise corn harvested area up 1.9 million acres. A lot of that in what I would characterize as the Western Corn Belt there in the plains from Kansas up through North Dakota. And so that has weighed on the overall supply estimate. Looking at the yield change here, I've highlighted from over the past 10 years or so, the monthly estimates starting in August through November relative to where the U.S. final yield has ended up. And I think my point here is that the August yield is sometimes close, but it's not always close. And so there is some uncertainty remaining there on that yield. I won't disagree that the growing season has been quite favorable across much of the Corn Belt. And so those high yield estimates, I think there's potential out there for that. But when I think directionally about which way those yields could change, I think there's more downside risk than there is upside, which would be favorable for the price outlook. One area on the balance sheet that I might have a little bit of concern with, so is the corn feed and residual use. I wonder if it's a bit too optimistic. So down here on the bottom in those bars are the combined index of grain consuming animal units. So it's a measure of underlying grain feed demand, where it takes the relative consumption of corn or feed grains in total for each of those livestock species and makes them comparable. When I look at the underlying demand from those livestock species into 25-26, we see a slight increase in hogs and poultry, while at the same time we see less demand from cattle, given where we are in the cattle cycle and where those inventory and herd dynamics are, and a slight increase in dairy. So overall, we see an increase of about 1% from those latest estimates, while at the same time we have a sizably noticeable increase in corn feed use that could have a potential gap there of something like 400 million bushels. And so I think that is a challenge when I look at the individual balance sheet components. Old crop corn exports for the 24-25 crop year continue to be very strong. And, we're between 2.75 and 2.8 billion bushels, looking at something like that, which is a few hundred million bushels more than we might have otherwise expected earlier in this crop year. And I think that works to support corn prices as we move into the new marketing year, despite the large supply estimates. When I look at sales for the 25-26 crop year, forward sales, we've seen good early sales, and given lower prices recently, I think we've seen a large increase in forward bookings of export sales, which I think is good for underlying fundamental demand as we go into the 25-26 marketing year. Looking around the world at corn crop conditions, I think the important takeaway here is that we see a pretty notable lack of yellow and orange color here in the major producing regions. There is some there in that Eastern European region just to some extent, but probably three areas I would point to here. Look at the good crop conditions in China, which I think to me indicates that the import demand that we saw from them over the past few years is probably less likely to be there this year. At the same time, we see blue down here in Brazil that's rated exceptional, and I think that relates to the current estimates of their second crop corn, and here in the U.S. also, and that matches up with the current high yield estimates that USDA published in August. When I look at the balance sheet in total here for 24-25 and then in 25-26, the two green columns here are what the USDA printed in the latest August WASDE, as well as in between here for 25-26, I have a few alternative estimates of what I think the balance sheet could look like given different assumptions either about area or yield. So there in that third alternative column, if we see harvested area come down slightly on the off chance that they maybe overstated their revision to area a little bit, and then we see yield back down once we start getting combines run through those fields. Um, we could still see prices in the high 390 or the mid 390 range or low $4 range even maybe, and that is after I account for what I think is an overstated feed use number, bringing that back down to about 5.8 billion bushels. Similar ethanol number in that scenario. And then I have an export number in here of 2.75 billion bushels. That's a little bit low below their estimate. If we do see export demand continue to remain strong and not just, taking early bookings to take advantage of the current low prices, we could see that in the low $4 range even. And so I think it's early. It's August still. There's some uncertainty about what some of these balance sheet components look like, but I think that kind of gives a range of possibilities for corn prices. I would highlight one downside risk. If they did correctly state area, and we do in fact end up with a yield in the upper 180s, and we don't use 6.1 billion bushels feed or residually, we could be looking at slightly lower season average farm prices into the 25-26 year. Moving on to talk about soybeans for a few minutes. We do have seen proposed RVOs that was largely positive for the soybean oil market, and then which carried over into the domestic use of soybeans on the crush side and soybean prices total. We also saw some updates to biofuel policy in the One Big Beautiful Bill Act, but we are watching to see what those final RVOs are this fall. I am looking for export sales to pick up here in the next few months to help support those soybean prices, but that is a risk as we move forward for the soybean market should those export sales not materialize. I'm also closely watching Brazil plantings as we move into September and when they start planting their soybean crop. Current estimates are in the 175 million metric ton production range, and there's some question of whether that could go higher given a short-term uptick in soybean prices following the August WASDE. When we look at the area change in the August WASDE, they reduced soybean area by 2.4 million acres, in a little bit in a variety of states. And so that served to shorten up that supply estimate a little bit and help to offer some upward price support, at least temporarily, to soybean futures. Similar story to corn. The U.S. soybean monthly yield estimates relative to the final, sometimes they're close, sometimes they can be off by a little bit. And given that a lot of that crop is determined now in the month of August, there is still some uncertainty whether we can achieve their yield estimate or not. Crush margins largely remain supportive for higher utilization rates for U.S. crush, helping to support the domestic use of those soybeans. When I look at what the EPA proposed for the RFS and the renewable volume obligation back in June, we do see higher demand for U.S. soybean oil, given some of the rules that they proposed for how RINs can be generated relative to the feedstocks or biofuel imports. And so I think on total that is supportive of the domestic demand for soybean oil, and likewise supportive for crush demand for soybeans. It will challenge the soybean meal prices, which could weigh on the crush margin a little bit. And I think we will look to export increasing quantities of soybean meal to help support those values. And even over the past year, we did see higher quantities of soybean meal exported, and so I think that demand is there for soybean meal exports. When we look at soybean export commitments for the upcoming marketing year, these green boxes are the April to current time period. It's over there on the right-hand side. That's the latest information that I had when I put these slides together. That was the July 31st export sales report, and how that compares to where we were in the past two marketing years. For 23, 24, we were, 150 or so million bushels, maybe even 200 above where we are currently. Even last year, we were a little bit above. And I think the big notable absence here that I want to highlight is on the left two marketing years, so 23 and 24. We did see strong Chinese buying. That's the orange bars there on the bottom, and that's a notable component that is missing from the 25, 26 forward export soybean commitments. And it gets back to what Matt talked about earlier as a large risk to the U.S. soybean market at the moment. When we look at the soybean situation in China, the top graph here in green is what the futures crush margin looks like. But I think it only tells part of the story. We've seen a slight increase in that crush margin here lately, but they are and do continue to import relatively more expensive beans from Brazil. And so I wonder if the cash crush margin might actually be a little bit weaker than what this chart might show. Over on the hog side, which is an important component of soybean meal demand in China, the profitability is quite weak at the moment, and by some measures, at a zero or slightly negative profit margin. And so I think that indicates going forward, at least to me, that the growth in meal demand and consequently soybean crush demand may be a little bit weak. Combine that with them securing a few cargoes of soybean meal from other destinations and actually exporting soybean oil to some neighboring countries. I think all of that points to some potential weakness in the underlying demand for Chinese soybeans. When we look at the question of, okay, they haven't bought any U.S. soybeans at the moment, and what might they need to do in order to completely avoid those going forward for at least the next marketing year? Maybe not forever, but at least maybe for the next marketing year. They need on average about 9 million metric tons a month. And this right component of the chart here, the 25-26 marketing year, is what their imports might look like if they imported only soybeans from Brazil and other countries. I think from a logistics standpoint, I think they could do it, and that does present a risk to us. Like Matt highlighted earlier, the majority of our exports to them do happen in that October, November, December, and then some in January timeframe during our major harvest season. Now, that's not to say we may not export any beans to them. When we look back to the prior trade war, we saw an absence in that fourth quarter and January time period, but we did see late season sales to them. And so while I don't have any U.S. beans factored into this scenario on the right-hand side, that's not to say it won't happen after we see meetings this fall and a potential trade agreement if that does materialize. Again, similar situation to corn. We look around the world at the major northern hemisphere producing regions, and we see a notable absence of poor soybean conditions. Early estimates for Brazil from the USDA and others are for anywhere from 175 million metric tons to 178 million metric tons, and that's up from the current year. And so we are looking at expanded Brazilian soybean production in the marketing year ahead. Looking at the balance sheet from as USDA printed it in August, there's a couple points here that I do want to highlight relative to 24-25, and those are the ones I've highlighted here in orange. We do see a notable increase in domestic use of soybeans, a slight decline in exports. A lot of that related to, or almost all of that related to, the increased demand for soybean oil for biofuel up there in the upper right, and consequently higher domestic use and higher exports for soybean meal coming out of that crush also at a lower price. We do see prices move down into the upper 280s on the soybean meal side. Some possible alternative outcomes to the soybean market. Again, the green columns here, what USDA printed in August, and here are some alternatives. Alternative three here again is, if we see area reductions that might have been overstated and weak trade related to, maybe China purchasing less U.S. soybeans on total throughout the marketing year, and some of that trade having to be reshuffled a little bit. We could see soybean prices fall, season average prices fall into the mid $9 range. And so I do want to highlight that as a potential downside risk related to this. Also, we've seen some groups start to oppose certain aspects of the proposed renewable volume obligation, some of the rules there. And depending on how that gets finalized this fall and what those look like, we could see changes to the soybean oil demand, which would flow over into the demand for soybean for crush. Again, if we see yields come in slightly lower, maybe, than what the USDA has estimated for August, and with lower area estimate, if that's turns out to be true also, we could see prices for soybeans rise into the low to mid $10 range. And so there is some upside potential there, at least, as long as we do continue to see strong demand for U.S. crush. I'm going to spend the last few minutes talking about some updates to farm policy. So in the One Big Beautiful Bill Act, which ordinarily made some changes to farm policy that ordinarily would have come through a farm bill, but this year was done through the One Big Beautiful Bill Act. We did see an update and increase to statutory reference prices, which also affect the effective reference price and ARC benchmark prices. So for a lot more detail on this, we do have a report covering a lot of those aspects on our website, the link there at the bottom. But there's a couple things that I would highlight here. So we did see reference prices for wheat, corn, and soybeans go from 550 to 635, 395, or sorry, 370 for corn to 410, and from 840 up to $10 for soybeans. And so there is the potential, at least, for soybean PLC payments to be made for the first time if we do see lower season average prices. Down there on the effective reference price, those are much higher because we are coming out of a high price environment. So another update they made to the effective reference price component is they shifted from 85% of the Olympic average historical prices to 88%. And that makes those effective reference prices react a little bit sooner coming out of higher priced environments. Similar story on the ARC benchmark prices. Those are in the $6 range for wheat, in the mid $4 range for corn, and in the upper $10 range for soybeans also. And so I think these do serve to offer a good floor for risk management for those producers who have wheat, corn, or soybean base. If current price estimates from the USDA are realized, we could be looking at wheat payments that are in the dollar range per program bushel, in the 50-cent range for corn, and in the 60-cent range for soybeans at current prices. Some other changes that happened in the One Big Beautiful Bill that are important is the ARC payment band was moved up to 12% from 10%. That does offer a slightly wider range of ARC payments under that program. One important thing I should also notice for the 25 program year, the producers will get paid the higher of the PLC or ARC payment that would have been calculated. And so since those rules were changed after program elections were made for this year, producers will get the higher of those. So in the case of PLC effective reference prices we were talking about just a minute ago, you should be able to get at least that amount. They are allowing up to an additional 30 million additional base acres to be added for the 26 program crop year based on the 2019 to 2023 plantings. And so that should give producers maybe that are a little bit short on base or a few other situations, some additional base acres to help support those operations in times of low prices. There were updates to the marketing loan rates, so you can borrow a higher value of that crop, as well as various changes to crop insurance and some updates to biofuel policy related to 45Z credit extensions, indirect land use change penalty. They removed that and some other things. I would highlight that the biofuel component here is law. And so we know these policy changes have been made, while at the same time, the changes proposed in the RVO have yet to be finalized. And so there's some differential uncertainty there on what those might look like. On the economic and disaster aid side, we've seen almost $8 billion of the $10 billion in ECAP paid out now. We are below the $8.5 billion. And so I do expect a large portion of that remaining amount to be paid out August 15th or thereafter. Here soon, I guess, is the short story there. They are working through the ELRP and SDRP programs, with the SDRP Part 2 slated to be rolled out sometime in mid-September or after.